Thank you so much for sorry.
Sorry.
Thank you everybody for joining us. Super excited to learn more about this topic. Like I'm exploring and learning too. So thank you so much for finding time to jump on with us today and share with us what could be a potential great opportunity for some of us that haven't taken advantage of it yet.
Yeah, thanks for having me. Thanks for Jim for setting this up. I guess I'll just start by saying, obviously my name is Jason Harrington. I'm with Jorns and Associates. Um, actually got introduced to this role. The founder of the company are some of my friends of 20 plus years. I actually officiated one of the guys' weddings, and they asked me to, kind of be in a role where I could, number one, work with businesses on navigating the complexity that involves qualifying for the ERC. And after I became really proficient in that, they asked me to kind of be able to have more upfront conversations with employers as far as how they could determining if they are eligible for the ERC. So our company, Jorns and Associates, we've been in this space since the beginning. We have over 13,000 clients. We've seen over $6 billion go out to our clients in a little less than 2 years through the Employee Retention Credit Program. There's not a whole lot we haven't seen. I mean, we dealt with about every company you can imagine all over the country. And we do find that there is a pretty high level of misunderstandings and misconceptions as far as how the ERC works. So let me go through this information. Let me see if I can do this right. Screen share. Oh no. Okay, maybe I'm not going to use the PowerPoint. I've got to quit it and reopen it. All right. Okay, scratch that. So
no worries.
We don't want to, stop midway. But I'll start by just saying the basics of how the ERC program works. So when the ERC was created, this was created alongside the PPP program. This came with the CARES Act in March of 2020. The PPP program and the ERC were initially a either-or program. You could get one or the other, but you couldn't do both. At the beginning of 2021, they passed new legislation called the Consolidated Appropriations Act, and this allowed PPP recipients to be eligible for the Employee Retention Credit, and it also expanded the scope of who can be eligible for the program, adding tax exempts and all the 501c category and things like that. The program has gone through 5 legislative changes. It is now almost 6,000 pages of legislation, over 100 pages of tax code. And needless to say, there's a little reason why most CPAs and accounting professionals are a little in the dark of how it works. If you haven't taken the time to develop specialized knowledge on it, it can be done incorrectly, often result in either playing the audit lottery or resulting in very minimal ERC refunds for companies because it's not done properly, or further delays just for IRS kicking stuff out for mistakes. So as I explained, we have a pretty large operation. We've got 4 offices, almost 300 employees, including teams of CPAs, forensic accountants, tax attorneys, even IRS enrolled agents that assist us with this process. It is a pretty substantial process. It can take 50 to 100 hours for us to process a company's claim before we even upload it with the IRS. It's 21 steps across 8 departments, from onboarding a company to closing their file. And it does take a lot of time to make sure it's done accurately, and we're not risking putting any audit risk out for the client with making a faulty claim. Now, as far as how the ERC itself works, the ERC, or Employee Retention Credit, looks at a period from March 13th, 2020 until September 30th of 2021. and you qualify for it on a quarterly basis. You claim it by filing an amended 941, a 941X. It's essentially amending your quarterly payroll taxes, and then you receive checks directly from the U.S. Treasury for each quarter you qualify for. It's considered an overpayment. Okay, so it's not a loan; it doesn't have to be paid back. It's essentially your payroll tax contributions coming back to you. With that said, it's fully refundable, meaning you could qualify for 100 grand in ERC and only have actually made 50 grand in payroll tax contributions during that time, and you would still get the 100 grand in ERC. It's a fully refundable tax credit. Now, how you qualify for it, there's a few different ways. You do qualify quarterly. That period of 2020 is worth a total of up to $5,000 per employee, whereas the period of 2021 is worth up to $21,000 per employee. But it's not all or nothing. You qualify for each quarter separate. You can qualify it by, number one, passing what we call the gross receipts test. And what that involves is looking at quarterly gross receipts for 2019 and comparing them to the same quarter in 2020 or 2021. And if you have any quarter in 2020 that is down 50% or more compared to 2019, that quarter would qualify. And if you have a quarter in 2021 that's down 20% or more compared to 2019, that quarter would qualify. Now, the most common misconception you hear about the ERC is that you need an overall loss of revenue to qualify. That's not necessarily true. It is required to qualify under that gross receipts test. If you don't have an overall loss of revenue that meets those thresholds, you can potentially qualify if your business had any operational disruptions due to government order that the term is limited commerce, right? So anything that could have disrupted business, like a full shutdown, a partial shutdown, some type of shutdown or mandate that impacted customers or suppliers, reductions of hours, inability to travel, inability to attend group meetings or trade shows. Any of these types of factors can come into play. And really,
Jason,
yes.
Janet had a question.
Yeah, Jason, we all run assisted living facilities, and one of our obstacles is we could not admit new residents for a certain period of time. So that would be a qualifier, wouldn't it? That would be a disruption in our service.
Yeah, absolutely. So the way you do it, and I'll give this as kind of a really specific, detailed overview of how it works. But when you're dealing with any of the qualifiers that is not that significant decline of gross receipts qualifier, you use a rule the IRS calls nominal impact. Now, and it sounds like a B movie that went straight to Amazon Prime or something. A bad band on 6th Street. So it says that if you have a nominal impact to at least the nominal portion of your business, that can potentially qualify. Now, what that means is you're looking at revenue, and instead of looking at it by overall, you're kind of looking at it by revenue sector, right? Which could be new patients versus existing patients. I don't know how all you define revenue, right? But if you're down in one area and that area made up 10% or more of the revenue and it was 10% or more down, then that basically meets the threshold, right? So you could have growth in a business in one area and have an impact to another area and claim ERC. Like an actual example in the ERC tax code is hospital, and it uses the example of hospitals stopping doing non-urgent care or non-urgent procedures during COVID. Overall, hospitals didn't lose money, right? But they lost money in that specific area because they were limited. They weren't allowed to do that during that time. So it's the same kind of rule. That's the type of thing that you guys would use. And ultimately, for us to determine if a business is eligible and how much they're eligible for, it requires a pretty deep dive into financial data, revenue data, and payroll data to determine. So it's kind of impossible to say 100% you can qualify or not until everything is looked at in depth. But that's the gist of how qualifications work. And so I guess to explain what it looks like, if anyone that's, on here, and I can put my information in a chat or Jim's information, Jim can get them in touch with me. But if anyone would like to have a more, detailed or specific conversation about, their facility in depth, or wants to know kind of what it requires to move forward with us, I'll give you a little rundown of how that process works. There is basically a few steps that you take. Number one, we have you do a registration on our website that just kind of puts you in our system. Number two, you sign an engagement letter with Jorns and Associates. This is just saying that you're going to hire us to assist you with your ERC. Number three, we take a deposit, effectively putting us on retainer at signing. It's $2,600. And what happens is, if a company goes through the process, let's just say for whatever reason they do not qualify for ERC, we do refund that deposit. If they do qualify for ERC, then the deposit comes off of our contingency fee on the back end, which is 20% off of whatever we recover. So if we can get you paid, we get paid. If we can't get you paid, you don't owe us anything. We will request 5 things after that. We're going to ask for, number one, a detailed questionnaire, where this is where you just give us, a bunch of information on our business for our internal staff. We're going to ask for quarterly P&Ls for 2019 to 2021. We're going to ask for payroll summaries and 941s for 2020 and 2021. And if you took PPP loans that were forgiven, we'll need those forgiveness receipt applications as well. And we'll take all that data, and we first have to calculate, what wages that we can use to determine how much ERC you could potentially claim. Then we have to prove qualifications. I always explain it like math class when your teacher made you prove your work, right? You got to show how you got there. So what we're going to do is we'll take the revenue data, the database of all of the mandates that were in place, and we're going to write a report that's going to say, hey, they qualify for this quarter using this rule, or this other quarter using this other rule. Excuse me. And that's where we determine what you qualify for. Okay. And excuse me, I'm getting over strep. One second.
While Jason is working on his throat there, are there
Got my
some
water
questions that folks have? Whatever.
So yeah, so just to wrap up real quick. So when we determine what you qualify for, we send you out the 941X. Our CPAs will send it to you. That's the form you sign off on that we upload with the IRS to determine receive your refund checks. So that's why we say it's up to 26,000. You may qualify for all 6 quarters. You may qualify for 2, 3, 4, or 5 of them, right? We don't know 100% until we get to that stage. And just so you know, this isn't going to be a shocker. The IRS is very slow. So they take, we've been saying on average, it's 4 to 6 months if you got it for any check to go out that's under 200,000, and it can be twice that long for any check over 200,000. But they sent out a notice about 3 weeks ago that said it's a minimum of 7 months period from when you file it before they will get to it. And between you and me, I think it has to do with what agent you get at the IRS. There's the agents that take pride in their work, and then there's the guy playing Candy Crush at his desk regretting his life decisions. So Probably more so on the latter than the former, but that's really the gist about how the program works and our process. It does take us several months on our end once we get all the required data to make sure everything is accurate and compliant. We want to make sure we get the maximum refund for the clients, but we also have to make sure it's done in accordance with the IRS guidance because we don't want to deal with any backlash. We offer 5-year audit assistance. We carry a pretty hefty E&O insurance policy for each client, and we try to make sure everything's done accurately, so we don't have further delays or cause any complications down the road.
Hey, Jason, it's Eric. If I can ask a quick question.
Sure.
What is your general turnaround time? I understand the IRS is going to take a while with their processing, but what is your turnaround time?
So we say an average is 8 to 10 weeks from when we get all the paperwork, and now that's going to be the determining factors are, number one, this is how often we'll get paperwork from a client and their bookkeeping doesn't match. Like, hey, your payroll summaries don't match your 941s. Until we fix this, we can't do anything, right? Or it also will be determined by how straightforward the qualifications are. So if it's your stuff's all right there apparent in the P&Ls that when you send them over, it'll be faster. If we require further revenue breakout, that can take a little more time, and that'll involve doing what I was mentioning, the sector data, separating revenue based on area to try to max the qualification. So yeah, Janet, that's probably a fair estimate, say within a year filing.
Awesome. Cool. If I can, you went through a couple items that were necessary. You mentioned quarterly statements, the 941. I'm sorry if I didn't get all my notes. What were the other items that you'll need from us?
So a questionnaire, quarterly P&Ls, payroll summaries, 941s, and PPP loan forgiveness receipts.
Thank you.
So the way that, if you don't know, since the ERC and the PPP were born from the same legislation, you can't double dip, right? So if you had PPP loans forgiven, the wages that were used to forgive the PPP loans have to be excluded from the ERC calculation. And one of the things that we do that's unique here at Jones and Associates is we have a software that's proprietary that we built out that allows us to balance the wages so we don't double dip and not leave money on the table. A lot of people, it's not like they do it incorrectly. They just do it in a way that it leaves money that could go towards your ERC, which you don't want to do.
Understood.
Hey, Jason, I have a question for you.
Sure.
So I just want to make sure I understand on the ERC program here. Are we comparing to be eligible the 941, which is payroll quarterly from 2020 each quarter with 2021 each quarter? Which one is qualify if down by 20% or more? Or are we comparing the revenues to be eligible on the ERC program?
Yeah, if you're looking for the overall decline, you're comparing gross receipts quarterly. So 2019 to 2020 needs to be a 50% reduction, and 2019 to 2021 would need to be a 20% reduction. But yeah, it's your gross receipts that you're looking at, not your 941 amounts.
Okay, so basically it's revenue, the gross receipt, the revenue that 2020 should be dropped 50% over 2019. If 2021 revenue dropped 20% or more from 2019, in that case, you're looking for the whole year. Is it quarterly or whole year revenue?
You have to look at it by quarter.
Oh,
yeah.
Okay.
You have to look at it by quarter. So, and Melanie asked if there's no impact. It's possible. So if there's not an overall reduction, it's possible if you show a nominal impact to a nominal portion of the business, which would mean, instead of looking at 2019 revenue by quarter as a whole, you're looking at 2019 quarterly revenue based on revenue sector. However you define that, I don't know, right? So if it's new patients versus existing, or any other way you slice it and dice it, right? I mean, that's what Janet said. You couldn't admit new patients. So you're, if you in 2019, let's say in 2019 quarter two, you had quarterly revenue of $250,000 and your new patient revenue was $30,000. That means it's over 10% of the quarterly revenue. So that's a nominal portion of the business. If in quarter two of 2020 and 2021, your new patient revenue went down from 30,000 down to 25,000, or whatever, as long as it reduced 10% or more, then that's considered a nominal impact to a nominal portion of the business. Meaning all your other revenue could stay the same, but you lost money in that one area of your business due to a limitation imposed by government order, then that can be a qualifier. The only really non-revenue qualifier involves reducing hours, and for an assisted living facility, that's not really going to apply because it's not like people are coming into your location to buy a product or service, right? So hopefully that answers everybody's question.
Okay, so sorry, next question. So if we comparing the revenue, then what is related with the one that earlier you mentioned that we will need to file the amended 941 on each quarter to be qualified. In 2020, it will be 5,000 per employee or something. So what is related the revenue drop here on the calculation to be eligible in order to get the ERC money using the 941 amendment? Because 941 is payroll taxes basically, right? Which is wages.
Yes, but so there's two things. There's determining that you're eligible, and then there's actually claiming it. So you file a 941X to claim it, but you have to be able to prove eligibility based on the revenue or the qualifiers, right? So
I see.
does that make sense?
Yeah,
So-
I see. Okay.
So the way the ERC works, it's called a tax credit, but it's actually looked at as an overpayment of your payroll taxes, right? But as I explained before, it's fully refundable. So it's actually not calculated based on your payroll tax contribution. It's calculated based on all the wages, the qualified wages that were paid during that time. So the more payroll that you have, ultimately the more ERC that you can receive, right? So, you use payroll to calculate how much you can get. You use revenue to prove that you're eligible, so you're not, putting yourself at risk for an audit down the road, and then they're asking for the money back. And then you use the 941 amended return to actually claim the ERC on the 941X amendment. That's actually where you claim the ERC, and it comes to you as a overpayment. That's what it's considered. So when you get the ERC, and this is something to mention, you need to be aware the ERC does have tax implications because it's a refund of payroll tax, and it would be considered a reduction of your payroll expense for the calendar year you receive it. Okay. So if you got ERC, let's say you get 50 grand for 2020 ERC and 100 grand for 2021 ERC, and all that money, let's say it came to you by the end of this year, you would not lump your 2020 and 2021 ERC together and pay taxes on it as if it's gross income for 2023. You would separate 2020 and 2021 ERC, and it would be a reduction of your payroll expense on that calendar year's amended return. So your 2020 you would have to amend your 2020 tax return, reduce your payroll expense by 50 grand. That creates a 50 grand increase, right, in your revenue. So unless you were running in the red that year, you're probably gonna have to pay some taxes on it. Depends on how you file and what your books were looking like that year. But that's essentially how it works. It's a reduction of payroll expense for the calendar year you receive it.
So I have a question with the amended, Jason, when you do, so we're already in 2023. We're already filing taxes. Most of us have already filed our taxes.
Mhm.
That's a lot of going back to amend all the years, especially your personal taxes when you have K1s attached to that.
Sure.
How does that all work out?
That's for your accountant to help you with. Yeah, that is not my department. But they're gonna require some, they're gonna have to amend all of that, all of that stuff. The thing is, keep in mind that no matter what you get back, what you end up with when it's all said and done, even if you're paying extra taxes on it, it's still, once it's all handled, it's your money. You don't have to do, it's not like PPP where you have to spend it a specific way. The money can go into the business and reinvest in the business. The owner can take the money and put it in their pocket. You can do with it whatever you want. But if you had us help you with your ERC, we're going to do the 941s. If your CPA or whatever accountant needs assistance amending or guidance, like amending the tax returns for the year you got ERC, we're happy to talk to them about how to do it, and walk them through that. But that's not,
Just said that money can go back to you personally instead of back into the business. How does that work?
Well, what I mean is once you get the ERC and the money's yours, so it's basically your money back in your account. You're not required to leave it there and reinvest it in the business. You could pull it out as a draw for yourself, or whatever you want to do with it. There's not a requirement on it being spent a specific way in order to not have to pay it back, like the way the PPP was.
So you could just write yourself a check for that amount.
If you wanted.
Spend it for vacation, Rachel.
Yeah, no kidding. I'm like, what am
Free
I doing
money.
here?
Free money from heaven. Free money
No,
from
seriously,
heaven.
one of the
So,
first
Jason-
clients I
Jason,
onboarded was my
Yeah.
my cousin. He's got a little regenerative landscaping kind of business. It's some real hippy dippy stuff. I don't understand it all. I think he spent a lot of time in Tibet and he does a lot of weird things with land. But anyway, they got back. Yeah, thought they wouldn't even get enough money back to pay for our deposit. They got back almost $130,000, and that was the first thing. He's like, oh, maybe I can actually pay myself something now, because they've been just wasn't even taking any money from the business because they're a newer business and they're still growing. So yeah, it's a much better program for businesses, but it does need to be done accurately, and you want to make sure that you don't have someone play guinea pig on the business trying to help you do it. I've had CPA firms where I talk to the person that handles their ERC and they admit that they're learning how to file by watching YouTube. And I'm like, what? Like, maybe I'll try demo in my bathroom for the first time. I'll try YouTube. I don't know if I'd want to try it for this, but
Jason, how many checks are you seeing for each person when you've been filing it? Does it come kind of all at once, or is it kind of a trickle effect with the checks coming in after you file?
Yeah, it depends on the amount. The bigger checks take longer, and
Okay.
yeah, heaven forbid they be efficient and put them all in one envelope, no. So it's really, I wish I could give you a definite answer. I've seen companies get paid in 3 months, and I've seen companies take over a year. It's not specific. I can tell you that our average, so we have completed about 12,000 of these filings. Our average return per employee is about 21,000, which is very high. We have a really high qualification rate because we got a lot of experience doing it. But that's taken from every size company you can imagine, all over every industry. Some took PPP, some didn't, but that's like the average we see. And you can take an average by looking at the amount of full-time equivalent employees you had in 2020 and 2021. So that's someone that works 130 hours a month or more. So that's where we come up with that figure, is we're averaging about 21,000 per full-time equivalent, right? So if you had two people working 65 hours a month, that counts as one full-time equivalent. And that just gives you an idea of how to kind of guesstimate what type of ERC might be on the table for you. I don't know how many employees each of your facilities have, but I usually tell employers, I'm like, look, take your number of full-time equivalents for 2020 or 2021, your average. You do have to exclude anyone, the majority owner, and anyone related to the majority owner by blood or marriage must be excluded from that number. And if you multiply that number times 21,000, that could give you an upper end range of what might be on the table. Now, we might qualify you for more than that, but I'm always like, hey, even if we qualified you for half of that, a third of that, I'll bet you cash the check. I mean, I'll pick up a quarter off the sidewalk. I don't care. So, it's a lot that goes into it to determine, but that can give you kind of an idea what's on the table.
Hey, Jason, there was previous literature talked about like thresholds, either max of 100 employees or max of 500 employees. Did that go away, or are there other ways and mechanisms to overcome that, kind of similar to the nominal impact?
No, that is still in place. And the way that's determined is that is 100% based off of the number of full-time employees. So you only count people that you had that worked over 130 hours a month or more. And that's based on 2019. So if you have 100 full-time employees or less in 2019, then you can qualify for 2020 and 2021 ERC. If you had over or 500 employees or less, so okay, let me say this a different way. If you have more than 100 full-time employees in 2019, you can only get 2021 ERC. And if you had over 500 full-time employees in ERC in 2019, then you cannot get ERC the traditional way. The only way you can get ERC if you had over 500 full-time employees in 2019 is if you either A, furloughed employees, you paid them not to work, or you laid people off and you paid their healthcare premiums. And in that case, either of those cases, you can claim 50% of their wages up to $5,000 an employee for 2020 only. So, which is fairly rare for people to have done that.
Understood. Thank you.
Did I explain that well? So over 100,
Yes. Yeah.
over 100, no 2020, basically.
Yep.
Under five, and if you're over 500, neither year under the traditional rules.
Yeah.
But
So
you do
going back,
have to make sure you look at your actual full-time count, right? Because you could have 500 full-timers and 3,000 part-timers and be fine, and if that was the case, you'd be getting a lot of ERC, because you still get paid ERC off of the part-timers' wages, but the requirement is based on what they define as small business, how they define a small business in 2020 versus 2021.
Jason, it's Rachel again. So when we were talking about like getting the monies, but you also said be aware because when you have to go back and audit, you may have to pay taxes on that income. Is that correct?
Yeah,
Depending through
Well,
the business.
yeah. So there is tax liability on the ERC because it's considered a reduction of your payroll expense. So, I mean, it's basically your payroll taxes coming back to you, right? So that's when you have that's a deduction on your regular tax return. So when you're essentially, since you're getting it back, you then have to reduce the deduction, right? So reducing the deduction creates more income for that year's tax return. So that's how you assess if you have to pay additional taxes on it is.
So
Yeah.
don't spend it all. Make sure you pocket or keep some of that money in case when you're doing your amended returns, because there might be some payback that you have to.
Yeah.
Okay.
Exactly. Right. And just so you know, like if a company tried to file the ERC, but they had backdated, like they owed payroll taxes, then you just wouldn't get the ERC. They would take it off of whatever somebody owed in payroll taxes, but it's separate. That's separate from income tax. But they do play off each other, which is important to know, so you don't just get it and think that once you get the checks that everything's handled.
So Jason, so if somehow we have engaged with the company that you have, so I just try to understand what kind of services that you will provide. So we will provide you the detailed questionnaire, quarterly P&L 2019 to 2021, payroll summary, which is 941, the PPP application receipt that we got, the forgiveness. Then from there, you will do your work to see if I'm qualified or not, eligible or not to get the ERC. And then if we do, you will do the application to claim, to file, and so on and so forth, including later on the amendment 941X. Is that what your services is all about or what?
Yep, that's perfect summary, right? So you engage with us. We take an engagement letter and deposit. That's effectively putting us on retainer. You send us all the required docs. We do all the calculations and qualifications. Once we've determined what you get, our CPAs will send you the 941Xs that you sign off on. Then we'll upload them with the IRS. And then we actually go a step further. We have IRS enrolled agents that work with our firm that allow us to monitor the status and communicate with the IRS on your behalf to make sure the claim is handled efficiently and that they didn't make a mistake. That has happened.
Your fee is basically 20% based on what we receive a credit on the ERC. Is that correct?
That's correct. Yep. And you give a deposit at signing of 2,600, which is refunded if you didn't qualify, or if you do qualify, then our fee is 20% minus the deposit, right? So it's all part of the same thing. And then Janet asked about how long this is available. So 2020 ERC has to be filed for by tax day 2024. 2021 ERC has to be filed by tax day 2025.
So people still have a good year, give or take a little bit. Yeah. Okay.
Yeah, and a couple things I do say, just to say not dilly-dally on it, is number one, increasing further delays. Number two, Congress has been known to change their mind about stuff. So they've already changed this. We have no control if they decided to, pass new legislation and, put it into it. As of right now, they are actually trying to reinstate the full spectrum of the ERC, which involves an additional quarter in 2021, which would mean the ERC would be up to 33,000 per employee, not 26,000. So the good thing is, if you work with a company like ours that's on top of all this stuff, if you begin the process with us today, and we 6 months down the road they add back in Q4 2021, we're going to come back to you and try to go after that, file that extra quarter for you as well. So that is the basics of what I've got. I don't know if anyone wants to put, give me their email or somebody I can forward an email to with all the information. I can send you an email of the steps that you would need to take to begin the process, and then send out so you have my contact information as well. So I don't know if everyone wants to throw their email address in a chat and I'll send a big group message out, or if there's one person here I should send it to. There you go. Peter's on it. Yeah, so I'll do that. I will put an email out, and what there'll be, if you want to move forward, have us begin the process, there'll be 3 links in the email. One is for the registration on our site. The second is to sign our engagement letter. Once you sign that engagement letter, it'll redirect you towards a deposit page, or there will be an additional link in case you did one and it timed out or whatever, and you need to do that. So if you do those 3 steps within 24 hours, maybe 48 if you sign up on the weekend, you're going to get an email from onboarding at Jordan CPA. They will assign to you what we call an onboarding specialist, and that person will work with you to get all the documents we need uploaded in our system so we can begin the process. And once you do that, we're off into the races, so to speak, and we're going to be working as quickly as we can to get everything done accurately. You will have my contact information in this email, so if you have any additional questions or need to reach out, feel free to reach out to me directly. If it's during business hours, email or text is best. I'm often on and on off of calls like this most of the time during the day, but I will definitely get back to you as soon as possible. So I guess that's all I got. Thank you all for listening. Sorry I had a
thank you,
cough fit in the
Jason.
middle.